Good afternoon. My name is Paulo Strito. It is a great pleasure for me to be introducing Vista Gold this afternoon at our Oktoberfest conference. We have here with me Mr. Fred Earnest and Pam from the company talking about the company's prospects for advancing the Mount Todd project in Australia and potentially expanding it through the drill bit. So without further ado,
Thank you, Paulo. Pleased to be participating in the Oktoberfest conference. I will be making some forward-looking statements. Encourage you to become familiar with this language. Vista Gold trades on the NYSE American and TSX exchanges under the symbol VGZ. We have just over 102 million shares issued and outstanding. At the end of the second quarter, we had $5.5 million in cash and have been very successful in monetizing non-core assets in the third quarter. I encourage you to look for our third quarter financial results in the next week. Our largest shareholder is Sun Valley Gold, followed by the Europac Gold Fund, Lowe's Corp, and Global Strategic Management. Vista's board and management own 3.2% of the shares of the company and have been gradually increasing their holding over time. We're delighted to have coverage provided by 4 independent analysts, including Derek McPherson from Red Cloud, and we would encourage you to go out and look at his research report. So why should you be interested in Vista Gold? I'm going to give you a few reasons. I'd like to just talk through this slide from the right to the left, a little backwards for some views, but our project, the Mount Todd project, is located in the Northern Territory of Australia. As it's presently designed, it would be the 6th largest gold producer in the country, with lowest quartile in country and global all-in sustaining costs. We think this is a very favorable location. We have an outstanding relationship with the local stakeholders and believe that our social license is firmly in place. Now, since acquisition of the project in 2006, we have conducted exploration drilling to triple the resource, extensive metallurgical testing and optimization to improve the recoveries from 81.7 to today just under 92%. All of the process flow sheet is designed on equipment that's industry proven and readily available. Our major environmental permits have already been approved, and we're working to achieve and gain the approval of the mine operating permit, or as it's known in Australia, the mine management plan. We believe that we're within a couple of months of that approval. All of the major infrastructure for the project is already existing. There's paved roads to the site, power line, natural gas pipeline, tailings impoundment facility, and freshwater storage reservoir. Our last technical report was completed in September of 2019, at which time we used a $1,350 gold price and a 70-cent foreign exchange price. The study economics were particularly strong at that point in time, and today they're exceptional, and we'll talk a little bit more about that. Now, all of this said, it's not our intention to develop Mount Todd on our own. Rather, we believe that it's in the best interest of our shareholders to find a partner to advance the project, thus allowing us to minimize the dilution to shareholders and at the same time maintain a very significant interest in the project. We're targeting a transaction of the style similar to the Gruyere project, a JV between Gold Road Resources and Goldfields, in which it's a 50-50 JV and has moved forward with some project debt and Gold Road's receiving cash that essentially covered their part of the CapEx. We enjoy a strong relationship to correlation, leverage, torque, whatever the term you like, to the price of gold, and we'll talk a little bit about that and why we believe that's the case. Our corporate strategy is simple. It is continue to de-risk the Mount Todd project. Our single most important project or task at this point in time is approval of the mine management plan. Second is communicating the inherent value of the project, especially at today's gold price, and then engaging in discussions with potential development partners. And we have a number of companies that have signed CAs and are undertaking due diligence work right now. We're hopeful that sometime in the first quarter of next year, we will be at a point where we can announce a transaction with a development partner. This chart simply shows you the leverage that we enjoy relative to the price of gold. It commences on the left on November 13th, 2018, the date at which gold broke out and began its upward climb. You see that with the exception of some tax loss selling at the end of 2019 and the period of time in February to April of this year when the markets reacted to the pandemic, that we typically outperform our peers relative to changes in the gold price. We think that this should be of particular interest to a potential shareholder or investor. This is what the project looks like today. You see it's a brownfield site. The plant site in the center will be the location of the new plant that we build. You see that there's a tailing storage facility. This has capacity for approximately a third of the reserves of the project right now. Freshwater storage reservoir. There's paved roads, as I mentioned, all the way to the plant site. The biggest change is that over the last 18 months since this picture was taken, the water level in the Batman pit has dropped about 25 meters. We're dewatering the pit and expect to have it dewatered by the end of spring next year, our time here in North America. The deposit that the project is based on runs below the Batman pit, extends for about 1.6 kilometers. The mineralized zone varies between 200 and 300 meters in width and is drilled out to almost 800 meters in depth. You see in the lower right the location of the project, very accessibly located in the Northern Territory of Australia, less than 3 hours from the international airport at Darwin, 30 minutes north of Catherine, a regional commerce center presently home to about 14,000 people. This project is designed as a community-based project, not as a fly-in, fly-out project like many of our peers in Australia. As I indicated, we completed our last technical report in September of last year. The economics are shown at the top of the slide. I'll not read those to you. I would remind you that they're at a $1,350 gold price. Today, at a better than $1,900 gold price and a 71-cent foreign exchange rate, the after-tax IRR of the project is over 44.4%. And the NPV5 is north of $1.9 billion. I think this just speaks to the leverage that we enjoy. I'd like to draw your attention to the graph at the lower part of the slide, the chart. This simply shows you how Mount Todd would stack up if it were constructed and in operation today. You see, as I indicated, that Mount Todd would be the 6th largest gold producer in the country. And you don't have to count the balls to realize that compared to our peers, we would be in the lowest quartile of all-in sustaining cost producers. Now, this is achievable basically for 3 reasons. One, this is a large project. At 50,000 tons a day, we're able to take advantage of economies of scale. Second, being a new project, we're able to take advantage of technology. And there's been a lot of technological changes in our industry in the last 10 years since Boddington and Cadia were commissioned. Specifically, we've adopted ore sorting, which is more widely tested and proven than it was 10 years ago. Last of all, as I indicated, this is a community-based project. It's not going to be a fly-in, fly-out operation. And as such, we won't have the cost of the airfare. We will not have a camp, nor will we be providing housing at site. And we won't have to have the 4th crew. Our labor requirements are about 75% of many of our peers as a result of our being a community-based project. To dig a little deeper into the project and the results of the technical study a year ago, you see in the chart at the lower left that our previous study was completed in January of 2018. In the intervening 20 months, we completed an extensive amount of additional metallurgical testing and process flow sheet optimization. We benefited from a small change in the gold price, changed from $1,300 to $1,350. Foreign exchange rate moved favorable to the project. Our test work resulted in a change in a selection of a different fine grinding mill. We selected the VXP mill, the FL Smith's VXP mill over Glencore's IsaMills. This resulted in reducing the grind size from 60 microns to 40 microns, and which resulted in an increase in the gold recovery from 86% to 91.9%. We also, as a result of having completed some internal evaluations, looking at causes for capital cost overruns, increase the construction period, change it from 18 months to 24 months. We also added a 6-month commissioning and ramp-up period, which we think will be reflective of actual conditions. You see the more detailed breakdown of some of the project economics. I bring to your attention just so that you're aware, the initial capex of the project is estimated to be $826 million. It's a big number for us. We recognize that that's the case, and it's part of the reason why we're seeking a partner. But on a use of capital basis, on an efficiency of capital use basis, is actually a very reasonable number for the size of project that's designed. The chart on the right just allows you to see the different changes that have resulted from, or the impacts of different changes on project economics. I would draw your attention to the leverage that we enjoy relative to the gold price, as denoted by the blue bars on the right side of the graph. Basically, for every $100 change in the price of gold, the NPV of the project increases $200 million. That's leverage to the gold price at the project level, and there's very few projects that we're aware of that enjoy this kind of leverage to the gold price. These next two charts just allow you to pick your own gold price foreign exchange rate combination and better understand the project economics. We've asked a third party to select a couple of peers or a handful of peers to which we can compare our project based on project size, state of advancement, permitting, etc. And what you see is that starting at the lower left, that our project is among the larger in this peer group. Now, we're not comparing ourselves to NovaGold or Seabridge. We're just simply not in their class. But at life of mine average production of over 400,000 ounces a year, this is a very respectable project. I mentioned the capex and the efficiency of the use of that capital expenditure. You see in the lower right a measure of capital efficiency, simply the initial capex divided by the ounces to be produced. And there you see that we're in the lower half, at just over $150 an ounce of capital per ounce of gold to be produced as the mine is presently designed. In part, this is due to the existing infrastructure that we enjoy, the fact that we don't have to build roads and power lines and pipelines and tailing storage facility. Now, the upper right chart, I think, is a chart that should be of interest to almost any investor, and this is simply a measure of value in the ground. You see the light blue bars for the single asset companies representing the number of ounces of gold per share issued and outstanding. And what this really points out is that Vista, unlike many of its peers, has considerable value in the ground. At 0.057 ounces per share, that's over $100 of value. And our challenge as a management team is to unlock that value. Now, like our peers, we have a large prospective land package, over 1,100 square kilometers of exploration licenses. The project located inside the boundaries of the mining license here, the red box in the lower center of the screen, covers a significant part of one of the two structural trends that we have on our exploration license package. And these are known to host gold occurrences. There's been gold mined in the district, the Pine Creek district, for over 100 years. We control a little over half of the Pine Creek geosyncline, and consider this to be a very prospective package. Of the $100 million we've invested, less than 2% has been spent on the exploration licenses themselves. We have rather focused on developing a project that will produce gold bars, and we have tremendous upside opportunity. This next slide just kind of gives you an idea. One of the things that's been completed in the last 14 months is a compilation of all of the geologic and historic exploration data combined with our data. What we see from this, looking at the chart or the section at the bottom, is that there's considerable continuity and mineralization within the Batman Driffield structural corridor. When we acquired the project in 2006, the drilling at the Batman deposit looked very much like it does at Quigley's, realizing that about half the deep holes here have been drilled by Vista. We subsequently, after acquisition, drilled over 60,000 meters of core at the Batman deposit, which allowed us to triple the resource and now report over 9 million ounces. We think that this continuity continues at depth to the north, and we have a drill rig running right now that's testing the first step-out drilling north of the Batman deposit, and we'll be announcing results from that and some additional drilling in the next 4 to 6 weeks. Now, just to kind of wind things up, and I'd like to leave you with a couple of key thoughts. First of all, with regards to the Mount Todd project, we believe this is an exceptional asset, and there are very few that are like it, both with regards to its size, the life of the mine, its permitting status, and the exploration package that we enjoy. Second of all, in the period of time that we've had the project, we have made a significant investment. This has allowed us to de-risk the project and to demonstrate technology that will allow us to achieve significantly better recoveries than previously thought possible. We have implemented the equipment or selected equipment for the project, which is industry proven and is in use at other operations. None of the equipment in our flow sheet, from the gyratory, secondary, HPGR crushers, the sorting equipment, grinding equipment, none of it is equipment that's still in testing. Rather, it's equipment that we can go to, visit, look at, talk to the operators elsewhere in the world. The project economics, as I pointed out to you, are very strong at the very conservative gold price of $1,350. And at today's gold price of $1,900, we believe that an NPV of $1.9 billion and an IRR of 44.4% is very compelling. Now, I want to leave you with the last thought. We are focused on value recognition. We are not going to build this ourselves. Undertaking the debt and dilution on a standalone basis to build this is not in the best interest of our shareholders. It's not our plan. We're seeking a partner. We have a number of companies that have signed CAs and are very well advanced in their completion of due diligence. We are moving toward the initiation of a more formal process and are hopeful that in the first quarter of next year that we'll be able to announce a transaction to move the project forward with a development partner. All of these things, I think, speak to the focus that we have of creating value for our shareholders. I'm going to just leave this next slide up on the screen. Paolo, I'd be happy to take any questions that may arise.
Thanks, Fred. That was a great presentation. First question I have here is from Al. What is the biggest risk confronting you?
Well, I think that we have done a tremendous job de-risking the project with permits, environmental permits in hand, and the operating permit soon to be approved. We have eliminated that risk. I think that the fact that we enjoy tremendous infrastructure, we don't face the same development risk that many of our peers do, and certainly capital cost risk has been minimized as a result of that. I suppose, like many companies, we're very leveraged to the price of gold, and we're dependent on a sustained gold price for the building value in the shares of the company. I would suppose that just volatility in the gold price is probably the single biggest risk that we face.